Thanks for joining us for the program. This is the third episode in a three-part series. The first one focused on pass-through entities and individuals, and the second one focused on corporate taxation. Both of those are available upon demand. This one will focus mainly on cross-border and multi-jurisdictional tax issues. We have an excellent faculty here for you today. We have David Agler of Agler Law, Stephanie Drew of Rubin Brown, and John Harrington, who heads our U.S. tax group here at Denton's. More information on us can be found starting at slide 31. This webinar is a production of Financial Poise. You can access the great free weekly newsletter by going to financialpoise.com/subscribe. As mentioned, if you're on the live premiere, you can ask questions through the question link. If you're listening to this on demand afterwards, just email to info@financialpoise.com. They'll forward your question on to us and we'll work to get back to you on your question. I wanted to thank our sponsor today, Max Assets, and also our co-producer, the National Law Journal. With that, let's get started on the discussion. So I will lead us off and then we will go to the panelists. So there are multiple kinds of insolvency, not just what people think of in terms of a bankruptcy that can have a tax impact. That can include an insolvency outside a formal process, a U.S. bankruptcy case, a receivership, often in state court, an assignment for the benefit of creditors, which is essentially a state law insolvency proceeding used in a lot of states like Florida, Illinois, California, rarely used in some other states, and debt workouts. And since this particular program is international focused, I wanted to mention that that the insolvencies can incur outside of the United States with a recognition processes on both sides. And just because a business is organized or located in a particular jurisdiction doesn't mean that will file there. For instance, there's been several businesses, including a Latin American airline, that have filed for U.S. Chapter 11 based on, some minimal connections to the U.S. So just because you think of the entity as not a U.S. entity doesn't mean necessarily that they won't file here. With that, I'm going to turn things over to Stephanie, and we're going to talk about some of the kinds of taxes we'll be covering today.
Thanks. So when we think about the types of taxes, especially when we're dealing with multi-jurisdictions, we have taxes that we traditionally see with companies operating in the U.S. So think corporate income tax. But we also have a group of taxes that you may not see if you're only conducting business in the U.S. For example, you may have additional withholding requirements. Those probably are going to be imposed whenever you have money leaving one country. So think dividends, interest, royalties, anything you have funds moving across borders, you should think about whether or not there's a triggering event. The other piece that I think is unique that we don't really have here in the United States are some indirect taxes. So for example, in the US, we have sales tax. Well, in a lot of countries, they don't have necessarily a sales tax that's collected at the end. So in the US, you buy a car, that's not part of the, you buy widgets, and you're going to pay taxes on those widgets when the consumer buys them at the end. Most countries or outside of the US, you have what we call VAT tax or GST tax. And the idea is that they pay taxes at every layer of input. So instead of having all the sales tax paid at the end, sales tax are the VAT taxes are being paid at every stage anytime goods transfer from one business to another. The other issue that we have, we'll talk about custom duties and tariffs, excise taxes, which are taxes on really select items that are imported into a different country. The other things to think about is that you can have payroll-related taxes in other countries as well. Think withholding taxes, social program taxes, you can have property taxes. The other thing that we don't necessarily have in the US, within the US, is we have this transfer price adjustments that can happen. And the idea is that we're trying to make sure that if you have activity cross-border, everything maintains that arm's length. Everything is in arm's length, especially between related parties. And all of these taxes, you still have an impact on them because a lot of countries, including the US, we have tax treaties. So we may have one rule, but those treaties are going to impact what actually gets collected for each different country.
Great. And Stephanie, can you also talk a little bit about the different kinds of taxpayers people should be thinking about?
Yes. So when we think about kind of in the United States, when we think about tax classification, that's actually the tax classification happens at the federal income tax law level, not necessarily the state that you are incorporated in. However, in other countries, they may have entities that aren't classified the same way you would think they would be in the US, and that can create problems with the way that entities are taxed and create additional layers of tax. So in the US, we have special rules kind of to classify these foreign entities. And foreign entities are really classified either as transparent and partnerships, or they are opaque, which is a corporation. And these are important things to think about because it has an impact on how they're taxed, not only in the US, but also how the owners of those entities are taxed.
Thanks. David, can you talk a little bit about tax claims? And here this slide's particularly focused on US bankruptcy, but feel free to mention any international aspects as well.
Sure. It's important to note that insolvency, including the filing of bankruptcy, does not exempt the debtor, and I'll use Stephanie's list, the debtor's subsidiary affiliates, officers, directors, creditors, guarantors, fiduciaries, and even certain asset purchasers from the application of federal, state, and local tax laws, including customs laws and tariffs. In the case of filing bankruptcy, and one thing just to build on something Bob said, and that is that Chapter 15 of the Bankruptcy Code deals with multi-jurisdictional bankruptcy cases where you have cases both internationally and in the US. So you should be aware of that. But getting back, so the fact that you have an insolvency does not affect or create a separate taxable estate for bankruptcy purposes. There's an exception if you're dealing with an individual that's filing a Chapter 7 or Chapter 11 case. Does not change the pass-through entity classification of the debtor, as Stephanie mentioned, does not terminate the tax year of the debtor, doesn't change the debtor if it's a member of an affiliated group that files consolidated tax returns, doesn't change the debtor's method of accounting. If you file bankruptcy, the Bankruptcy Code has an extensive mechanism or scheme to address tax claims and all claims, including excise taxes, import taxes, tariffs, okay? And in the case of tax claims, the bankruptcy court has the ability, which is discretionary, to determine certain pre-tax claims as well as claims during the bankruptcy, which are administrative claims. And that is not available in the case of receiverships or other kind of non-bankruptcy workout cases where at least the federal government has certain sovereign immunity rights as to courts determining their tax liability. The bankruptcy code also has a priority scheme for payment of claims, and secured claims have high priority as to their collateral, but the bankruptcy code does potentially limit the amount of a secured claim to the value of the collateral, and they bifurcate or can bifurcate claims into secured claims up to the value of the collateral, and the remainder would be unsecured claims. After secured claims, there's cost of bankruptcy administration, meaning administrative expense claims. They include taxes incurred during the operation of the bankruptcy. Employee claims have up to a certain cap, have priority. Then there are priority unsecured claims, including tax claims, which are covered under 507A8 of the Bankruptcy Code, and then equity. 507A8 also addresses claims for customs and for tariff cases, which now may become more prominent given all the tariffs under President Trump.
And a couple things I would add. One is, especially with the number of kind of foreign organized entities that have been filing Chapter 11 in places like Houston and New York, David accurately laid out the U.S. priorities, but employees often have more favorable priorities in Europe, and whether a European court or European, union will recognize those priorities, could be disputed. There's also why most tax claims look back 3 years. Um, um, Customs duties generally look back 1 year, but sometimes they're assessed in arrears. So often they're collected when the goods come through the custom clearinghouse at the border, but sometimes there can be a determination later that a custom duty was owed for a past period. So, just have that on the radar screen. Um, Stephanie, can you talk a little bit about U.S. taxation when the entity is foreign organized?
Yeah. So when we think about whether or not a foreign entity is going to be subject to U.S. taxation rules, we want to think about what those main triggers are going to be. And we kind of consider that, do we have an economic nexus? So that economic nexus is really, was there significant activity within the United States? Physical presence, source of the income, do we have assets in the U.S.? Or is that entity, does it have control of individuals or corporation that are within the United States? So if you're a foreign corporation and you have no connection to the U.S., you're generally not going to be subject to the U.S. tax rules. But if you are what we call a controlled foreign corporation, a CFC, and that means that if you have U.S. shareholders that control more than 50% of either the voting rights or the value of the company, you can end up subject to those U.S. tax rules. For foreign partnerships, we have that, most of them, you still have that same issue of passing those tax attributes down to the partner. And if there is an economic nexus with that partnership, then it's those partners that get subject to the U.S. tax rules. Unless there's an exclusion. So one of the things when we're just thinking about general U.S. tax, we have a lot of these, there's a rule, and then there are exceptions. And those exceptions come in the form of treaties and agreements between the various countries. But one of the things, especially when we're looking at partners of a partnership that are subject to US tax, there are a lot of special withholding rules that get applied here. And, as we talked about before, if you've got funds moving across a border, you can expect a triggering event. Or there's an event and you need to see whether or not that actually requires you to have withholdings. For example, if you have fixed payments, which are a series of payments that are the same every time, those can be subject to up to 30% withholding in the United States for those before those dollars get transferred over to a partner outside of the United States. So you've got that 30% withholding as a rule, but if you have a tax treaty, that can either provide an exemption so you don't have to have any withholdings, or it can lower the rate down to 10%. One of the things when you're thinking about withholdings generally, especially with cross-border issues, I think that just from a planning tip, it's better to err on the side of over withholding, because you do not want to end up in a position where you didn't withhold and now you have to pay those withholdings to the government. The other issue that we have with US taxation of foreign entities is called the Global Intangible Low Taxed Income Tax. And the idea with this is that it is a sort of minimum tax, a minimum level of tax that's going to be applied to US-owned foreign corporations. So again, we have that 50% control of US persons, or 50% control of the value of the stock. So that's kind of that we said that was our nexus. So then the next layer down from that is if you are a shareholder and you own at least 10% of that current controlled foreign corporation, then you're going to be subject to this GILTI tax. And the reason that these are important is because they, again, they're important because the whole idea behind these rules is that what you're trying to do is the United States is trying to make sure that if you have companies that have a nexus with the United States, those companies are not shifting profits from the United States to a lower tax jurisdiction. And that's kind of what they're trying to do. They're trying to make sure that the United States gets all the taxes that they're entitled to.
Thanks. We talked about this a little bit on our prior program, but there's often restructurings where debt is restructured or exchanged. John, can you kind of refresh us on that, and also highlight particular aspects that where the international has special concerns?
Sure. Thanks, Bob. As you point out, we talked about this in the prior two prior series in terms of exchanging sort of old debt for new debt. And the primary issue that comes up in the purely domestic context is it a taxable exchange? I mean, clearly, if you exchange one instrument for another, you have a disposition for tax purposes. But as we discussed before, you can have a significant modification to an existing instrument, a debt instrument, and that can cause it to be a deemed exchange. And so, again, sort of for a domestic creditor, the question is like, is this a taxable exchange? And we addressed, we talked about that issue in the prior, like I said, in the two prior episodes. The one of the wrinkle that's going to come up here in a cross-border context with a domestic creditor is going to be if the foreign jurisdiction also sees that taxable event and imposes tax. Now, the foreign jurisdiction may not, particularly if it's a deemed exchange that only the U.S. sees. But if the foreign country, if another country does see this taxable change and imposes tax, it can be very difficult, if not impossible, for the U.S. creditor in that case, the U.S. lender, to take a foreign tax credit. There's some existing foreign tax credit regulations that basically say that's not a credible tax if the foreign country imposes tax, because from a U.S. perspective, that's U.S. source income. We source it based on the residence of the of the person doing the exchange. Certainly if it's a U.S. person that resides in the U.S. So that would be U.S. source income, and that either is not going to be taxable as a legal matter under some existing final regulations or under some prior regulation, which you can currently elect to apply in lieu of those final regulations. It may be technically credible, but it's still U.S. source income, and you can't take from a practical standpoint, you can't take a credit on it. So there, I think the issue there would be you want to ideally avoid any foreign tax as part of that exchange because it's not going to, from a legal or practical standpoint, not going to be credible for U.S. creditor. Um, the other aspect to probably notice from a U.S. creditor standpoint is going to be if it's there's potential foreign currency gain or loss. And this is true with payments, certainly true on exchange. If the loan is in something other than what's called the functional currency of the creditor. So if you're a U.S. person, it's U.S. dollar. If you make a loan in euros or Canadian dollars or Mexican pesos, it's going to be you can have gain or loss on the payments, including the exchange. The one other item to sort of point out on in the context of a creditor is if it's a controlled foreign corporation, just like Stephanie mentioned, it may not be subject to tax as long as this isn't, U.S. This isn't U.S. taxable income, effectively connected income. The shareholders may be subject to it, the United States shareholders, and so the gain is potentially either subpart F income or what's at least this year called GILTI. Next year will be a net CFC tested income, but there can have an impact on the shareholders, not on the company, which is analogous to what we talked about with the pass-through entities and that Stephanie talked about. But that's sort of the wrinkle on sort of on the sort of the U.S. creditor standpoint, whether it's directly or it's the owner of a controlled foreign corporation. Now, if it's a foreign creditor, foreign lender to a U.S. borrower, there's some there's a whole nother set of issues to potentially think about in the cross-border context. Now, to much more in the domestic context, the issue often is this taxable, and for a foreign person, except in one case we'll talk about, they really don't care if it's taxable because they're not generally subject to U.S. income tax on the exchange of a debt instrument. The exception is if this debt instrument, this loan or whatever we want to call it, that's treated as an interest in debt, if it is part of the conduct of a trade or business by the foreign creditor in the United States, if it creates something called effectively connected income or ECI, which Stephanie talked about in the taxation of U.S. entities, and if it is effectively connected, say the creditor is involved in a lending business in the United States, or it's somehow got employees or agents, and this is in the United States, and this is associated with that activity, then there can be gain. That is subject to U.S. income tax, subject to normal U.S. income tax rules, because this is engaged in a trade or business in the U.S. It's unusual, but in the typical case where you've just bought a debt instrument, that's not going to come up, although we'll talk about where it can come up if you've done that. But generally, it's, that you just worry about the effectively connected income. Now, that's the rules for income in terms of taxation. The flip side is the loss, that you can't deduct a loss unless it is part of that effectively connected income, part of that trade or business. So, it's good news or bad news, depending on whether you have a gain or a loss. Two sort of things to point out, I think, on this as well. Even though the exchange itself may not trigger tax, again, if it's not part of effectively connected income, there often is accrued but unpaid interest, particularly if this is distressed debt, and that the exchange does trigger the payment of that, or the deemed payment of that accrued interest, and that can be subject to withholding tax. Stephanie mentioned the instances where it's not because of a treaty or portfolio interest. But if this instrument is subject to withholding tax, then you can trigger withholding tax, even though the gain's not subject to U.S. tax. The withholding tax the interest could be subject to withholding tax. Um, the one instance I want to sort of bring up in terms of the foreign creditor to kind of watch out for is when something goes from not being effectively connected income to becoming effectively connected income. And this is the instance where a creditor, again, sort of a non-U.S. creditor uh, has a debt instrument. The debtor gets into the borrower gets into financial distress, and the terms of the debt instrument have to be renegotiated. And as we talked about before, if there's a substantial modification, a significant modification, that can be, result in, kind of a deemed exchange. You're getting one instrument paid off and entering into a new one. If this is an isolated event, this is just, this is the one time it's come up and you deal with it, it's probably not going to be an issue in terms of renegotiating that and having a different, having a deemed exchange as part of a renegotiation. But if this is happening on any kind of regular basis, you've got multiple loans that are having to be done, or this happens pretty much on a, like every, um, uh, uh, this happens every year. You do have to worry about this, being considered engaged in a lending business. So then instead of acquiring debt that's potentially eligible for the portfolio interest exemption, rather this, foreign, the foreign lender is considered to be entering into loans. It's not really just acquiring an instrument. Then you've triggered the U.S. income tax from lending activity, and that new instrument is subject to U.S. income tax because it's viewed as lending. It's an unusual set of circumstances, but it's just something you have to be careful about if you have multiple. They said this is not an isolated event, but you regularly deal with distressed debt. There's a risk that you are actually um, uh, you are actually engaged in debt. If we can go back to the slides, I think we're
Can I raise one issue?
sure.
To supplement what you and Stephanie said, and that is the issue of FERPTA, which lawyers or anyone on this seminar, if you've sold real property or bought real property, you've seen these statements under IRC section 1445 that I'm not a non-resident or foreign person selling real estate. But the rules under FERPTA is that if you have a U.S. real property interest, which can include either real property, stock in a U.S. company that owns real property, or certain debt instruments, that the gain from the sale of that property, okay, or in this case, an exchange of debt, that's a FERPTA interest, okay, that constitutes effectively connected income for U.S. tax purposes, meaning trade or business income. And it's also subject to a variety of withholding tax rules by the buyer. And so it's important when we're talking about, the issue of either this fixed and determinable interest, determinable payments, FDAP it's called, or ECI, that if you have a U.S. real estate interest debt that gets exchanged, sold, or even purchased, you may have withholding tax issues on those transactions because they would be taxable if there's gain.
And we discussed that it's called guilty for this year, but will be called something different next year. Is that just a name change, or are there any substantive changes to the treatment?
It there there are there is a, I would say, a slight modification because they're the because we already used the word significant modification in the debt exchange rules, but there are several changes to what it's almost like talking about Prince, the thing formerly known as Prince, but what used to be known as guilty with the there are several changes, one of which is that you can take a larger foreign tax credit against GILTI. It used to be limited to 80%, now it's 90%. The amount of GILTI, if you're again, these are really if you're a corporation or a domestic corporation or an individual elected to be treated as a domestic corporation, the inclusion amount has gone up. That you used to be able to exclude, 50% of it. Now it's dropped to, I think, only 37.5%. No, it's around 40%, I think, of the exclusion amount. And then there's also a change in the calculation. You used to be able to exclude something called the deemed intangible uh, return, sort of a return which is gave it's the reference to intangible in it. That's dropped out. So on net, it's a slightly tighter set of rules than in the past, but it really depends on your circumstances. You could be better or worse off depending on the level of foreign taxes. But I don't know if the others have a view or not, but it's it's mostly a name change, but it's more than a name change.
Great. Well, we're going
Um,
to try to make this.
actually, actually,
Oh,
um,
go ahead.
actually,
Go ahead.
actually, if you don't mind, let's go back to the prior slide, if that's okay. Because this actually is a lead into what David was talking about with the uh, in terms of the particularly with FERPTA, the the issue in the exchanging sort of old debt for new debt. The area, particularly in the cross-border context, that you have to, I think, what particularly be concerned about is, again, with particularly with a foreign lender, is if this isn't necessarily a debt for debt exchange, but rather it's conversion of debt into equity. And I think we talked about this again in the prior series about in the domestic context, there are repercussions of that. That's on its face a taxable exchange. There's exceptions for that if, under there's special rules if you're converting it into a partnership or if you're converting it into a corporation. So it may not be taxable in that situation. For a foreign person, again, it doesn't matter if it's taxable or not because it's as long as it's not a U.S. real property interest like David referred to, or it's effectively connected income, then you're not subject to tax. But you've changed the nature of the holding, and that can be a really big deal to a non-U.S. person that's holding this. Because if you've just got a debt instrument, like David brought up on the FERPTA rules in terms of the taxation, generally a debt instrument doesn't trigger the taxation under FERPTA. And, the interest as a creditor is an exception to that. On the other hand, if you go from having a loan to a domestic corporation, or you have or a loan to a partnership, that that's not that itself, that's disposition doesn't trigger tax. The income from flowing that isn't triggering income tax. But if you switch that over to from debt to effectively an equity interest, if it's in domestic corporation, you've got stock, and and Stephanie mentioned the withholding tax under FDAP. Dividends and interest are both subject to 30% from the statutory rate, but often the rate is lower than that. You can have a zero rate under portfolio interest. You can get a lower rate under treaty, and usually in both of in the treaty rate is usually lower on interest than it is on dividends. So you've gone from having something that may be subject to no withholding tax rate as interest because of portfolio interest exemption, or it's subject to a lower rate under a treaty. And now what's coming out from what used to be the creditor standpoint is now dividends, and they're subject to a higher rate of tax. So from a corporation standpoint, you may have suddenly increased or started incurring withholding tax that you didn't originally plan on because of that conversion. And for the reason, and as David pointed out with FERPTA, you went from having a debt interest to now having stock. And if that's a U.S. real property holding company, then then when you s- then when you when there's a disposition of now that stock in that company, it's taxable under the FERPTA rules when it wouldn't have necessarily been subject to tax as debt. the real issue here, I think that can really trip people up or create issues is if, as part of this debt for equity exchange, it's a pass-through entity. It's an entity treated as a partnership for U.S. tax purposes. If it's engaged in a trade or business or holds U.S. real property, then the the that that the who was the person that was the foreign creditor is now a foreign partner in a partnership. And so they're receiving income from that partnership. And if it's engaged in a U.S. trade or business, that's effectively connected income. That that foreign person now has to start filing U.S. income tax returns, filing, paying U.S. tax. If it's corporations, subject to things like the branch profits tax. There's a lot of issues that, historically, foreign investors, you know, try to structure to minimize the administrative burdens of doing that, even if they pay more tax, just avoid those filing obligations. So it's just something really to watch out for if you're representing the a foreign lender in this situation. But it's also relevant, if you're on the other side, just anticipating the issues that will come up, so you don't have a last minute sticking point. Is that is that's a significant change. The tax consequences are quite great. Administrative burden is much greater. And so it's just something you have to be very mindful of it if one goes down the road. So there really is an exchange of intentional or unintentional of debt for equity, particularly if it's a pass-through entity, if it's a foreign lender.
Thanks. We're going to go through 4 practical examples to make this a little more concrete.
Bob, can I just
Yeah,
interject?
of course you can.
Okay. And that is, we've been focusing in on the foreign party, the lender. Okay. And I want to go back to our first 2 seminars, and that is everything that's been discussed here, whether it's a debt modification, a reduction in the debt, okay, a conversion of the debt to equity, also has potential tax issues for a U.S. debtor. Okay, so those include potential cancellation of debt income. There is a bunch of cancellation of debt income rules for different scenarios where you do a debt for debt, okay, where you do a debt for equity, where you have a capital contribution, if that's how the debt is going to be resolved. And so it's important that the debtor understand that it may end up with some sort of cancellation of debt income. And that raises the issue of whether or not it would qualify for any kind of exemption, bankruptcy exemption. I'm just doing this quickly. The insolvency exemption, the exemption for example, interest that may not have been deducted yet that would have been deductible. If that ends up getting canceled, and I mean canceled for tax purposes, not necessarily legally, okay, then that also, may be an exemption that the debtor can use. Also, in the case of debt that is in a partnership, okay, where you're converting equity into a partnership, that may have affect the other partners because it may cause them to have debt reallocated away from them that they took losses on, that then may end up resulting in additional income to them or taxable distributions. So just keep in mind that there's another party to this when we're talking about these cases.
Thanks. So let's go through 4 examples. 2 are outbound focus, 2 are inbound focus. So John, maybe lead us off, but I throw it open to the whole panel on, the outbound situation where the CFC is the debtor.
Yeah, sure. Thanks, Bob. Okay, so here in our facts, we've got a sort of a foreign borrower, foreign debtors, foreign corporation, and it has 3 shareholders. One's a U.S. person that owns 60% of its stock. There's another who's a non-U.S. person who owns 35%, and you've got a U.S. person that owns 5%. And for this purpose, let's assume that they're all unrelated, because we do that because they're constructive ownership rules, and if they are related, then the percentages can change, notwithstanding what the legal ownership is. The ownership for for these purposes, these controlled foreign corporation rules can change. But so let's assume they're all unrelated. The foreign corporation has $100 worth of debt that's forgiven by the lender. Um, and let's assume that the country has is kind in this regard. They don't have the U.S. cancellation indebtedness income, so there's no tax that's associated with this. This is purely something that exists from a U.S. tax standpoint. So from the foreign corporation standpoint, if it's not engaged in a conduct of U.S. trade or business, it doesn't have any U.S. tax impact the on the corporation itself. But because it's a controlled foreign corporation, because we have a U.S. person here, A, who owns more than 50% of the shares of the foreign corporation, it's a controlled foreign corporation. So we have to look at the impact on its shareholders. And for GILTI, again, for 2025, net CFC tested income in the future, um, there's there's $100 worth of income. A is allocable 60% of it. So it's $60 that would be considered guilty or net CFC tested income. It's usually cancellation deadness income isn't subpart F, but it can be this guilty net CFC tested income. So 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 A has an inclusion of $60 in this case. B and C don't have any inclusion because they're, one's a foreign person and the other is on below the threshold to be a United States shareholder under Section 951B. So you have this situation, which is something I think we talked about in the very first of the series with the flow through entities, where the entity itself doesn't have tax consequences, but the owners do, and it affects the owners differently because of, the owners have different tax attributes. This is an analogous situation, and it's relevant, in this situation because it's, this could affect, the CFCs if A controls the FC in this case, its willingness to, to engage in a transaction because its impact on that. So it's A's problem, but it can be everybody's problem if it interferes with the, with the restructuring of the debt. I don't know if
Thanks.
David or Stephanie have anything to add, but if not, we'll go to FC's cousin here on the, um, so this is a foreign corporation, but in this case, the ownership's different. It's not three, it's not concentrated in three owners. It's got multiple owners. No, all the owners are unrelated, so we don't get in the constructive ownership rules in terms of counting, amounts of ownership. And everyone owns less than 10%. So we have no United States shareholders for this test. So FC is not a controlled foreign corporation. So same facts before, you have $100 worth of debt forgiven by the lender. Um, this would be, the guilty net CFC tested income, but there's no United States shareholder, so it doesn't matter. And so therefore, there's none of the shareholders there's not direct tax consequences to any of them. There's one set of weird set of rules if this is a passive foreign investment company and it's made a QEF election, a qualified electing fund, where it's could kind of matter, but that's pretty remote from our facts. But it just shows you the difference in the situation. Just because but if you compare these two examples, a foreign corporation, each case of foreign corporations isn't affected by cancellation of deadness income, but in one case, there is an impact on the shareholders because it's controlled foreign corporation, and the impact is uneven because it's only affecting some of the shareholders. So this is intended to illustrate not just its impact in these particular cases, but also the contrasts about, how it can, that it can matter to the shareholders of foreign corporation, but it really depends on the circumstances. And that's it for me.
David, or Stephanie, any other observations on this scenario?
I just say, and it kind of goes along with everything that we're talking about. These rules are really, really complex. If you just look at when we talked about in the last couple of programs, it's complex if you're just dealing with domestic companies and domestic activity. And when you layer that foreign activity on top of it, it just exacerbates the joy of trying to figure out how these transactions work, not only at the entity level, but also at the shareholder level. And so you want to make sure that if you are involved in these kinds of transactions, that you make sure that you have the right folks to help advise so that you don't create more problems than what you intended.
Thanks. David, do you want to lead us off on walking through the first inbound scenario?
Yes, in the example we have, and this is foreign partnership with foreign partners that acquired a note issued by a U.S. borrower. And for simplicity, let's assume that the acquisition of the note occurred at original issue. You can talk about what happens if it purchases the note and purchases at a discount. But this note has a 5-year term, principal payable at maturity. The U.S. borrower develops cash flow problems, requests that the loan and principal payments be extended. Okay, so the loan is extended 1 year, and the extension is not a significant modification. And what that means is we've heard Stephanie and John talk about, modification of debt. And for tax purposes, a significant modification of debt is treated as if it's an exchange of the old debt for new debt. So all of the things that tax consequences John and Stephanie mentioned would apply. And for purposes of the creditor, the exchange may be taxable, either a loss or gain, or actually, depending upon the terms, deemed payment of the accrued but unpaid interest, or even if it's purchased at a discount instead of original issue, you may end up with discount income. To a foreign person, if this loan is structured in the example as a portfolio interest loan, why that's important is because that's an exception to the 30% withholding rules on interest payments. So any deemed interest payment to the foreign person in a portfolio loan should be exempt from tax. And in this case, the assumption is that the foreign partnership is not engaged in a U.S. trade or business. Otherwise, any interest or any gain from the modification would end up being taxable under the effectively connected income rules as business income, and business income is taxed on a net basis as opposed to the FDAP income, which is taxed on a flat 30% subject to reduction under treaty or exemption for portfolio interest. So under the significant modification rules, okay, a modification is defined as any alteration, whether it's an addition or a subtraction of any legal right or obligation of the issuer or of the debt holder. And significant modification means that if these alterations are economically significant. And the regulations that are cited under 1001-3, okay, those regulations address 5 different situations as to whether or not a change is significant. And one of those is change in timing or amount of payments, okay, including maturity, change in maturity of an obligation. And under the rules, a change in timing of payments of the lesser of 5 years or 50% of the original term of the debt instrument is treated as a significant modification. So in this example, you have originally a 1-year extension, which does not meet the significant modification rules, okay, in a 5-year original maturity. But then if the loan is extended for an additional 5 years, this would be a significant modification. And again, what that does is that has an effect on the foreign person This is portfolio interest, doesn't matter. As to the debtor, it has a potential issue in that the debtor may end up with cancellation of debt income. And again, that raises the issue of whether or not the debtor can qualify for some sort of an exemption under the cancellation of debt rules. If this foreign partnership does the modification, and let's assume the modification may even be multiple, if they do a modification where they're making multiple different loans, or if they've had additional loans that they've made, that may cause the foreign partnership to be qualified, I'm sorry, to be doing business in the US for tax purposes, may be qualified under state rules as well. And you may have a situation where it has to file tax returns and report income. And if it is effectively connected income and they file the proper form with the debtor, then the debtor is not required to withhold. If I change the rules a little bit, change the facts a little bit on this example, and if instead this note did not have portfolio interest, okay, but instead had an equity kicker to it, okay, and if the debtor entity was a U.S. real property holding corporation, then the debt instrument could be treated as a U.S. real property interest. That's what we discussed. And its exchange, any gain may end up being subject to tax or may be subject to withholding tax as well. Any points?
Stephanie,
Yeah,
John.
just one thing I was going to add on this is that if you go to those particular facts that we're talking about with a single loan, and this just shows through the interaction between kind of quality and quantity here, where suppose this weren't just one loan, but this were 100 loans, and it makes a big difference the length of that extension of time period, because if you do this for 100 loans and it's not a significant modification, then there's no change in those. If you do this for 100 loans and it winds up being significant modification, then you've got 100 new loans, and that looks very different. Yeah, it shouldn't, but it does. It looks very different in terms of whether you're get continuously or regularly engaged in sort of a lending activity. So it seems strange that it's the same act, but the length of time can make a difference whether you're considered engaged in a conduct of trade or business, because entering to 100 new loans is sounds like you're doing a lot of this, but it's not because you did 100 new loans. It's just entirely based on the length of the extension that you gave.
And we have one final inbound scenario. David, do you want to lead us off on this one as well?
Yes, this is sort of similar to the prior example, except we've got a foreign corporation. Let's assume that the foreign corporation is not engaged in a U.S. business, trade or business. The debt qualifies for portfolio interest. In this case, the foreign corp converts the debt into equity of the borrower. That has consequences potentially for both the lender and the borrower. If it's portfolio interest, I mean, this may qualify under the tax-free reorganization provisions, depending upon whether the debt is treated as a security for federal income tax purposes. If it's not a security and it is taxable, again, putting aside the issue of this being FERPTA obligation, which doesn't appear to be, then the exchange or conversion of debt into equity shouldn't be taxable to the foreign corporation. As to the U.S. borrower, it's treated as if it extinguished the debt for the value of the stock that it gave. And what's important about that is, to the extent that the value of the stock is less than the debt, there's cancellation of debt income to the to the to borrower. If you're if the post effect, and John mentioned this, is that the foreign creditor is no longer a creditor. Okay, it's now treated as a shareholder, and so any distributions that are dividends are going to be subject potentially to withholding tax to the foreign corporation. Foreign corporation may qualify for a tax treaty that reduces that 30% withholding tax, but it does change the dynamics. If the U.S. borrower is a partnership, meaning a pass-through tax entity, then once and John raised this, once you have a foreign partner in a partnership, U.S. partnership that's engaged in a trade or business, you're going to have a pass-through of that income to the foreign partner, and the partnership is required to withhold and pay to the IRS, and state rules may also apply here differently, but withhold on the allocable share of the foreign partner's income. And that may raise some issues regarding the operation of the partnership because it may affect their cash flow. And I'm looking at the example. If FC becomes a partner in a partnership, it has to file U.S. tax returns. It will get a credit for any withholding tax on its behalf. And if FC is a foreign corp, it's also subject to the branch profits tax if it doesn't reinvest the proceeds in a U.S. trade or business. And that goes to issues of whether or not they receive distributions or not. And they're also subject to something that's not covered here, which is a branch interest tax if it borrowed money to fund the U.S. operations.
Thanks. We have one more topic to cover before we move on. Any other observations, Stephanie or John, on this scenario? Otherwise, we'll go to our final topic. All right. Stephanie, can you walk us through credits for foreign taxes paid to foreign taxing entities?
Yep. So up until now, we've talked about all the taxes that are due under the U.S. taxation system. So it's all taxes that we have to pay into the IRS. But because the United States, we have tax laws that tax you based on your citizenship, that means that you're going to pay taxes on all the worldwide income that you have. And in some cases, you can end up with taxes not only paid to the U.S. for income, but you also have paid income tax to foreign countries as well. And so the U.S. tax system says, well, we really don't want you to have double taxation. So they allow for a tax credit for those foreign taxes that are paid to another country. However, there are rules about when and how you can, well, there are rules about if you can actually take the credit. And so in order to take it, it has to be foreign income tax, and it has to be either income or in lieu of income tax. So we talked about some other types of taxes that you have to pay. Those aren't going to qualify for this. The other piece is that the tax that you pay has to be legal and an actual liability for the entity or the individual. And you have to have foreign source income to be able to take the tax credit related to the income. One of the things from a insolvency perspective, I think we talked about this historically in these other programs, that when you have cancellation of debt income, there are exclusions where you don't have to pay taxes on that cancellation of debt income. But even though you don't have to pay taxes on it, you still may have to reduce the attributes of the remaining assets. And this foreign tax credit is an asset when we think about attributes that have to be reduced for CODI.
Well, thanks. We're at the end of our hour. I wanted to appreciate the panel for a very substantive discussion, not only today, but for all three episodes. Financial Poise has the other two episodes plus other restructuring and bankruptcy related programs. So I highly recommend that. But I wanted to thank the panel and thank the audience.
Thank you.
Thanks.